We've got some key developments in what are the world's biggest risks. Everything that we thought about them 6 months ago, they're still there and they're still progressing in the wrong direction. In fact, they're becoming more of an issue, not less. Those two big risks are China and US commercial real estate. And we got some key updates in both of them, including a big drop in CNY today, as well as some new information on US commercial real estate that sheds some light on what up until now has been largely hidden from public view. It's been deep in the shadows. One of the limited windows that we have into those shadows, though, is the bond market. And there's been a palpable downward bias to market interest rates, and that bias is directly tied to these big risks and a few others, which we'll talk about, and risks that are becoming more reality as we see in these key updates and developments. Now, that downward bias isn't stimulus, it isn't loosening, and it isn't really about central banks at all. Downward bias in interest rates, that's lower growth and especially inflation expectations, which means that, among other things, a higher degree of demand, generally speaking, for liquidity and safety, the type of downside possibilities, flight to safety, that always means rates go down. That's not a good sign. So let's start with these updated developments in US commercial real estate, including a pretty troubling report that came out just a couple days ago. What it said was, firms bought back a record $1.3 billion of delinquent loans last year, according to JP Morgan and Chase and Company. Increased stress in this market has forced managers to take unprecedented steps to protect the integrity of their CRE CLO structures, strategists led by Chong Sin wrote in a report last month. And this is interesting because CLOs, that's something we've been focusing on and going to continue to focus on because it tells us something, or it may tell us something about potential liquidity, not just credit defaults in the credit situation in the CRE space, but how that is being perceived and how that is being carried out in actual market trading, because CLOs are the most liquid part of any of these esoteric credit markets. And what they're talking about is CLO managers are buying back bad loans before those losses in those loans could be assigned in the credit structure. We have to keep in mind how CLOs are set up. Like any other ABS securitization, they have what's called a waterfall structure. And the waterfall means that all of the cash that comes in gets assigned to the senior pieces first, and then if there's more cash flow left over, which there should be, it then goes to the mezzanine pieces before finally the equity, which is the most riskiest and the one that's first in line to get credit losses and last in line of the cash flow waterfall. And so the CLO managers that are using their reserves to buy back bad loans, what they're saying is they're making up for what should be a shortfall, because what we're inferring here is that these CLO managers realize that if they allow these losses to be assigned as they're supposed to in the securitization structure to the equity pieces and maybe even into the mezzanine, though probably not that far, that would likely have an adverse effect on the entire CLO space at this early stage, which means they have very little faith that if they start assigning losses to some of the equity pieces, it's very likely that the marketing and the sales and transactions and bidders and buying in CLOs would simply fade away. It would seize up. Credit would stop flowing. The markets would stop flowing. They become increasingly illiquid, which raises all sorts of bad possibilities, especially for any situation where anyone might have to be forced to sell. So if we're already at a possible illiquid market at this early stage, what happens when there actually is selling of some of these CLO tranches? That's not a very good sign to start with. And it goes even further, back to the report. Market watchers say that may partly explain why the share of loans in CRE CLOs with payments more than 30 days overdue actually fell to 7.4% last month, based on data from analytics firms Credit IQ, after peaking at more than 8.5% in January. That continuing this year, CLO managers using their reserves bought back even more bad loans from the overall CLO pool. Because again, there's more bad loans there and they don't want to assign the credit losses because they're afraid. This is again what we're inferring from all of this, They're afraid that if they do, the entire marketplace would shut down, and then that would raise all sorts of other bad negative possibilities. One other thing, another measure of CRE, CLO loan stress from Citigroup that uses different criteria touched 4.8% in January, the highest in data going back to 2014. So there's two critical pieces of information here. One is that CLO managers are not all that constructive on the CLO marketplace. They're taking these unprecedented steps to use their own cash reserves to try to keep everything whole as much as they can. And the other piece of information building on that one is that the amount of bad loans in these CLOs is substantial already and likely rising. Only reason why the one metric fell, the amount of loans 30 days overdue, was because of the prevalence of this unprecedented activity. So managers are not constructive on the CLO marketplace, even though this thing is still getting started, and we're getting more information that this thing is actually getting started and is becoming more of an issue. Not a whole lot that's good here. And one person who shares that perspective is a fellow by the name of Carson Block, who is a famous short seller. And just a couple of days ago on Bloomberg Television, he had this to say. Short seller Carson Block said his firm has grown, quote, more bearish on Blackstone Mortgage Trust, citing troubles with multifamily properties. The Muddy Waters founder expects the publicly traded trust to cut its dividend in the second half of this year, he said Tuesday in an interview with Bloomberg Television. Block said he suspects that the property market's woes are probably in the, quote, early innings, and that the tumult may spread beyond office buildings, which, we're really talking about multifamily apartments here. Back to Block. This kind of reminds me of 2007, he said, noting that there was a moment after the failure of Bear Stearns' hedge funds in early 2007 where the general market sentiment was that, quote, there's been deleveraging, everything's okay, and it turned out not to be. Now, I think that's probably taking this a little bit too far because the 2008 analogies, they're not going to fit these circumstances. But I understand what he was saying. What he's saying was that in that early stage, people could see that things were going wrong and things weren't right, but there was still that sense, okay, confirmation by really recency bias. Nothing bad was going to happen because something like this, somebody was bound to be able to fix it at some point, especially the Federal Reserve. Everybody believed in it back then. So it seemed as though, okay, this might be some problem, but it doesn't seem like it's going to go too far. Of course, we have to also keep in mind here, Carson Block is a famous short seller, so he's going to be quite pessimistic by nature. However, I think the bigger point here is that what's not like 2007, what we do need to be paying attention to, is the fact that many financial firms, regulators, and everyone else involved did learn some lessons from back then. Back then it was, hey, just you got something bad, get rid of it before you have a chance, before the market has a chance to kill you for it. So just liquidate, sell, get out, get out, get out. Liquidity structures, there's very little redundancy. But in 2023 and now 2024, it's the opposite. Everybody's doing everything they can so that there cannot be price discovery of any kind. In fact, we just talked about that with these CLO managers dipping into their reserves to buy bad loans. They're doing everything they possibly can so that everything just kind of stays the same. It's 180 degrees in the opposite direction of 2008. But that doesn't necessarily mean it's any better. Just because we're doing things the opposite of what was the worst crisis since the Great Depression doesn't mean we're going to avoid one this time around. In fact, there are other challenges to deal with, including what we started out this video talking about. Everything takes place hidden in the shadows because we don't want anything to happen. We don't want transactions to go through. We want as minimal disruption as possible, as minimal price discovery as possible. It leads to potentially, first of all, not potentially, but in actuality, more and more information asymmetry, but then potentially mistrust. And therefore, then you get to this familiar 2007, 2008 blanket naked selling. If people lose enough faith in the marketplace because they're not getting information and they know they're not getting information, it can lead to even bigger problems in terms of maintaining that facade, maintaining just normal operation in some of these marketplaces. And as those might be imperiled, it then can spill over into wider and wider concentric circles across the financial marketplace. Now, to be clear, Okay, that's what Carson Block was sort of intimating, that there's that potential, but I don't think we're anywhere close to that yet. But we are seeing what I've talked about in that webinar I did not long ago on commercial real estate. We are seeing that it is a major problem and there are major risks associated with it. And as we go further here in time, those problems are bubbling up more and more. We are getting a little bit more sense of it, even if it's still largely hidden in the shadows. And if we get too much of it, and it starts to trigger more of that fear instinct, then that's where we really have to be concerned, especially as it might lead to forced liquidations in a marketplace that might not be all that liquid, even at this early stage. And that's one reason I believe there's such a downward bias in interest rates, because there are tremendous risks here. It doesn't mean we're going to be careening off into a 2008 crisis, but it could be bad enough that it leads to some amount of financial volatility, financial losses, as well as economic damage. That's really the combination of all of these downside pressures. So lower interest rates are simply lower growth and inflation expectations. As we talked about yesterday with the Swiss National Bank, the central banks around the world are catching up to where the markets are on inflation risk. There really isn't any here. And now that the markets are increasingly pricing, again, following the post-rally pattern, which means that we had the big rally last year, which was lower growth and inflation expectations being priced in a rally, almost historic fashion. And then after the rally takes place, rates kind of go sideways to slightly higher for several months. And that's exactly what they've done. So they're following that historic pattern, which means we have to ask, are all the assumptions that went into the big rally, or all the perceptions and realities that went into the big bond rally last year, are they still there? While people have said, well, rates are going up because central banks are more hawkish. No, rates are going up because that's the post-rally pattern. And so what we're saying is that being consistent with that post-rally pattern suggests that all of the fears and perceptions and everything that went into the rally are likely still there. And that's exhibited in this downward bias to interest rates as it goes through this post-rally period. So the sideways to slightly higher is still the same thing as the big rally last year. And that's what we're saying with all of these major risks that we keep seeing more and more pop up throughout all of the developments that we've seen just recently. I mentioned commercial real estate. Another big one, of course, United States economy, maybe the labor market, consumer spending might not be as strong. The European economy, Europe is in really bad shape to begin with, and it may be getting worse. Those are key critical risks. But above both of those, China. China has been wrestling with an economy that continues to sputter along at best, as well as a huge real estate crisis, a bigger one in China than we're talking about here with commercial real estate in the United States. And the real estate crisis in China keeps bubbling up too. Again, it's largely hidden from view, but we do get glimpses into it. I mentioned China Vanke and some of the big developers, and China Vanke is a big one because it's supposed to be one of the good ones. We keep getting a sense that it might be one of the good ones, but now what does a good Chinese developer actually mean these days? Over the last actually couple months, going back to mid-January, quite conspicuously, China's yuan has been largely butting up against the floor or hitting down against the floor that's likely been in place, again, in the shadows by China's central bank, the PBOC, along with the big policy banks acting on its behalf. And that floor, that soft floor, has been right around 719 to 720. And it's been maintained on and off, really going back to the middle part of January, but since the early part of February, right through the National People's Congress gathering earlier this month, they don't want to be upstaged by anything bad in the marketplace. So to an extent, it was expected that they wouldn't allow the currency to really freely float during the National People's Congress. But now we're far enough away from the party Congress that there's less manipulation, less attention to this soft floor. And suddenly today, CNY drops to around 723 to the dollar. So big move down. It's the lowest since November. And it suggests that what I talked about earlier, video earlier this week, that there is a downside bias in the currency because there is not a lot of faith in the Chinese economy, nor its ability to handle this real estate monster that's lurking in the shadows. State media reported a little bit over a week ago, back on March 12th, that 12 major banks, including the 6 largest state-owned lenders, were in talks to provide a syndicated loan for Vanke worth as much as 80 billion yuan to enable the company to meet upcoming repayment deadlines. And then a little bit later, there was an announcement of a possible loan, a smaller one. The Shenzhen-based developer said in a statement filed with the Hong Kong Exchange late on Tuesday that it had obtained a 1.4 billion yuan loan from Industrial Bank for 14 years. That's a long time for just that little amount. Based on a 35 billion yuan guarantee authorized during a shareholder meeting held in June. What the Chinese are trying to do is to nurse the real estate sector through this next little while, not because they're interested in bailing out developers and getting everything back into the same way it was before. Their biggest concern, and what's really becoming clear here, is that the government simply wants these developers to finish all the projects that have been stalled, all the ones that they've started and have been unable to finish because of all of these liquidity problems, all the developers that have to focus more on bond payments and debt and meeting just basic day-to-day needs. They're just trying to get all these developers to finish what they started, which is not the same thing as maybe what most people have in mind when they see some of these rescues and bailouts put together. They're not necessarily bailouts in the same way we might understand them here. They're simply trying to get the real estate developers to do what they said they were going to do because they don't want to harm, at the end of the day, whoever owns the property that's going to be developed on the other side. And so they're not trying to restart China's property bubble. They're trying to slowly decelerate it to the point that it doesn't become disorderly. They're still letting the air out of the bubble because they realize China's economy is not going to continue to flourish. It's not going to continue to act in the same way it had before because that avenue is shut off. It's shut down. So rather than try to just throw more bubbles at the problem, they're trying to clean up these bubbles. But in cleaning up these bubbles, it puts tremendous risk and tremendous strain, not just on the Chinese system, but the global system overall. There is potential for spillover across the rest of the world too. So as China's yuan falls further again today, and today is Friday, March 22nd, when I'm recording this, as China's yuan starts to fall even further again, breaking through the range that's been in place for quite a period of time here, going back to where it was last year on the downside, it suggests that for everything that has happened along the way in the months before now, none of it has actually worked. And we see that in the economy, despite the fact that China reported better than expected economic statistics, as I pointed out in Eurodollar University's daily briefing. We go through this every couple months with China. They report a little bit better than expected macroeconomic statistics. The media says China's turned a corner. When you actually dig into the stats, you see they aren't any different whatsoever. What happened was expectations get beaten down so much that they just beat up expectations. And it leads to the cycle where everybody gets excited about China's economy outside of the financial, monetary, and economic system. Inside could not be more different. So China's yuan falling even further, another recognition, another sign from the shadows that all is not well in one of the world's biggest risks. It's, again, everything the Chinese government has done, and it has not produced the desired results. Downward bias in interest rates, not just in U.S. treasuries, but around the rest of the world. It's not about central banks. It's about these major risks that we keep butting into and butting up against, that because they're still there. They're still progressing. We still don't have enough clarity to say that this is all fine and good. In fact, we have more and more evidence that suggests that it isn't fine and good. One of them, commercial real estate, CLO managers using their reserves to buy up bad loans because they're afraid of what might happen if they start assigning those loans. That's not a good sign. China's yuan falling pretty sharply, 7.23 to the dollar, breaking past that floor, maybe heading to a much lower level. We'll see how that goes. That's not a good sign either. And behind all of those, the one limited window that we have into these hidden spaces, downward bias in interest rates that are still following the rally post-rally pattern, which means all of the assumptions, all the perceptions that went into the rally are still there in the marketplace. And then as central banks they pivot to rate cuts, as the Swiss already did, that's just a recognition of everything that the market has been putting forward and putting in front of us over these past several months. Lower interest rates are not a solution to these problems. They are confirmation that they are problems. The Swiss National Bank shocked the world recently when they actually cut rates. And they cut rates because they said, we know everyone else around the world is going to be cutting rates too, getting to where the markets already are. That's the video I've got linked below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.